Good morning, traders, and happy Friday. I'm Jill Malandrino, global markets reporter at Nasdaq. And for this edition of Trade Talks, we're going to jump into the debt markets, particularly in the area of commercial real estate. I'd like to welcome Tony Barkan. He's the managing principal and chief investment officer of Allagash Partners, an emerging manager focused on commercial real estate markets. Tony's been trading and managing risks since the 1980s and has been on the investment side since the late 90s, including most recently having spent 8 years as a founding principal and head of commercial real estate investments at Sear Capital, an asset management company with $2.5 billion assets under management at its peak. Tony, I'd like to thank you for joining me at MarketSite today. This is an interesting topic for us. We don't typically delve into the debt market. So generally, can you give us a few metrics to put this space into context for us?
Sure, Jill. Thanks for having me.
Of course.
Absolutely. You know, it's interesting. People don't tend to think of commercial real estate as a large market as a whole. They really tend to think of it in terms of, if at all, their local mall and how's that doing, or they hear about an office building in their area that may have transitioned and they wonder about that. Very different from residential real estate, where we see all the published metrics and the market being thought of as a whole. In fact, the commercial real estate market is a $16 trillion market in the US. And for points of comparison, Nasdaq is about $12 trillion in total capitalization, and the entire equity markets in the US, as represented by the Russell 3000, is about $28 trillion. So you've got a market that's 57% of the entire equity market. People don't tend to think about it. In fact, it's as large as the aggregate equity markets in Europe or the aggregate equity markets in Asia. And in fact, it's really underrepresented from a manager standpoint on top of that. You've got, for every equity manager, you've got for every 10 equity managers, you have less than one manager in commercial real estate. And investor portfolios are even more underrepresented. As a result, investors don't really see the opportunities that often. They're not being shown them. Right. And that's why we started Allagash.
All right, let me ask you about those opportunities. What do investors need to know about? But I have an even bigger question that's big in the equity markets right now. Commercial real estate and brick and mortar stores going by the wayside with the likes of Amazon. What are your thoughts on that in a more broader sense?
Sure. I mean, listen, real estate, the old saw is location, location, location. And commercial real estate is not dramatically different. It's really very site specific. So even with these large themes, we're not going to lose retail stores. I do think if you take a step back, you can think about it in terms of how people shop. And the way people shop in urban areas is different from the way people shop in suburban areas or country areas. For a lot of places, it's really a lifestyle center. It's where people go to get their nails done, to get their taxes done. In some places, to do their laundry and to do other things they need to do during the day. It's also, you know, if people know where the goods are in the store, they like going to that store. And I don't think that's going to change for a majority of the country. It's easier in the larger urban areas to understand how we might order our paper towels and our toilet paper and get them in the mail. But I think it's unlikely that that trend is going to continue overall. So I think that the fear is a little overblown. I think it's still a significantly powerful trend, and it has an opportunity to move specific equities in certain ways, because again, it depends on what they own. But I think as a whole, retail is going to survive in the country.
That's a really interesting viewpoint, because we tend to think very coast-centric,
yes,
considering that we follow the markets in New York City, so we're always looking at that theme. That's a really interesting viewpoint that I had not taken into consideration before. But let's get back to the opportunities. What are some that investors need to know about within this space?
Sure. I think there's one really large trend. The biggest trend is that over the next 5 years, we're going to see $2 trillion in commercial mortgage debt come to maturity. In order for the owners of the properties to refinance that debt, they're going to need significant capital infusions. And we're talking to the tune of at least $100 billion, and some analysts have measured it as large as $200 billion.
Right. Well, $100 billion, that's a big number to look at just over the next 5 years. So how has this issue been developed?
Sure. You know, much like the economy as a whole, the narrative for commercial real estate is very similar. There are haves and have-nots. And in fact, as you mentioned, relative to what we call the gateway cities, which are the tier one largest cities that ring the country, as examples, New York, Chicago, San Francisco, Dallas, Miami, those 12 or 13 cities have performed, they're the haves. And the real estate in those areas represents, by value, a large share of the real estate in these indices, and that's what's driven for what attention we get in commercial real estate, the indices have gone higher based upon those markets performing so well. The have-nots are represented by the rest of the country. So if you own a $1 billion office building in San Francisco, you're not going to have any trouble refinancing your mortgage. But if you own a $75 million office building in the middle of the country in Columbus or St. Louis, Cincinnati or Kansas City, that's going to be a significantly greater problem, and you probably will need some level of cash infusion. To put a quantity on it, if you look at that $75 million peak value, let's say in 2007, the owner of that property could take out a mortgage at about 80% loan to value, so they could borrow $60 million. Today that property is unchanged, maybe down a little bit, let's say a $70 million property, and today they can only borrow 60%, so they can only borrow $42 million. They've got to find $18 million in order to refinance the property and keep the property. When you multiply that over all of the assets that are under that refinancing pressure, you get well over $100 billion.
Right. Well, it sounds like there's a big market imbalance playing out, and we're kind of seeing that income disparity even happen in the commercial real estate world. So my question to you is, are there actual trading opportunities around this?
Absolutely. We have to think about it from the owner's perspective. They've got two choices with respect to how they're going to finance their property and get that extra capital. They can either sell equity or they can raise debt. To the extent that they sell equity, we know how much they're making. They're making about 15% after you account for leverage and total financing costs. That 15% would be their cost of selling equity. If they and they give up the upside as well to the property. In the meantime, if they raise debt in the form of mezzanine debt below their senior mortgage, as long as they're paying less than that 15%, it's going to be accretive to equity. And we think that's really the single best opportunity in the marketplace, because these are performing assets that are doing well. They're not in big cities or the fanciest properties, but we think that if you can lend to a good property and make high single digits or low teens returns, unlevered, that's a very powerful investment. There is a second investment that falls off of this opportunity, and that's that some of these owners are going to get the capital and others won't. And those that won't, their loans will turn into non-performing loans. Again, there's not enough capital allocated to that sector, nor enough managers in the sector to take up that entire volume. As a result, there's going to be some great opportunities to make really compelling IRRs over, really not that long a term, 2 and 3 year periods, holding periods in these assets. In fact, the greatest opportunity is to combine those. You get the high yield of the debt, plus you get the non-performing loan IRR on a total return basis. You put those together, you get very good, stable, repeatable returns over both shorter and longer terms.
Right. Well, your investment thesis seems pretty straightforward. How come more managers aren't looking at these opportunities?
There's a big barrier to entry.
Why is that?
Well, the access to the marketplace is hard. These are not assets that trade on screens. They're not even really broker-dealer markets. You've got to be able to access the participants in the marketplace, the actual lenders, the borrowers, and special servicers with respect to the non-performing loans. Going out to all those people, it takes having a real team that's got a lot of expertise. Expertise is another one. The commercial mortgage space, the commercial real estate space in the US has 300,000 properties. Compare that to the Russell 3000 with obviously 3,000 equities in it. It's a very different marketplace. All of that takes cost. So there's a big barrier to entry. Now, we are not the only people looking at it by any means. There are some of the biggest investors who are looking at this. And they can do it, but they have a different type of fund, and I'll talk a little bit about that in a second. You've also got some small focused investors who are looking at particular assets. But we think that at Allagash, what we've tried to create is a unique and hopefully advantageous solution. What we've done is, first of all, we put together a tremendous team. Along with me, there are going to be 8 other partners at the firm. We've got together, just in the senior team, over 200 years of experience in the business. So we've got the access, we've got the experience, we've got the ability to put this together and to create as optimized returns as we can for investors. As well, we've put together a strategy that is really meant to perform over the full market cycle. So we don't just have the short-term yield and the longer-term opportunities. We're also putting in liquid trading strategies as well as the ability to short, because as the market environment changes, we want to be able to change with it.
All right, so let's talk about that fund. This is called the Credo Fund.
Yes.
Is that correct? Let's hear about
Correct.
that.
It's a commercial real estate debt opportunities fund. It's our first offering. And we've put it together in, I think, a very interesting way. First of all, the capacity is tremendous. As we talked about, we're talking about a $15 trillion market, $2 trillion in debt that's maturing, and 100 to 200 billion of capital required. So I think there's actually positive economy of scale for the fund, up to 2 billion on day one. And we should be able to invest 2 to 3 billion a year going forward. And as a result, we've wanted to create an open-ended fund because we think the opportunity is going to be significant. So we've done it in a hedge fund format, but I think in the long term, as we look back, the standard hedge fund methodology really has not aligned investors with managers well. You've had a situation where, because they charge incentive fees on mark-to-market, markets can go up, they get paid, managers get paid incentive fees, it sets back down, and the investors are just worse off. What we've done is we've created an opportunity for investors to have liquidity, which is appropriate for the asset class that we've got. There is enough liquidity in that space. And we've got a situation where the fund only charges incentive fees on realized gains. So we only charge money to ourselves, and we only get paid if the investors get paid.
All right. Well, thank you very much for joining us at Nasdaq MarketSite. We look forward to having you back for updates in this quite exciting space.
Thank you very much.
And thank you, as always, traders, for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.